Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, April 5th, and then we'll see how things look for Thursday, April 6th. We had another day that was a decline, not a real significant decline, but we still have to step back and take a look and say, is the market just retreating before it gets set to go higher, or are things starting to shift? You can make a case for either side right now, so we just follow the charts day in and day out to see what's happening, and then make our evaluation according to that. A few things to take care of before I get into the video. From April 22nd through May 11th, I will be traveling. I intend to post daily videos at least. If I can, I'll post the weekly and other videos as well. Right now, I don't know if I'll be able to post any videos. I don't know if I can get my equipment across the border. I don't know what my internet situation will be, but I intend to post daily videos. I also have a podcast that you're able to access on YouTube. It's pretty much a carbon copy of what you're seeing right now. There's also a PDF of all the slides and charts that I go through, not only in the description for the podcast, but also in the description for each video. I do have a private Facebook group that you're welcome to send me a request to join. I do have a poll that's posted. I'm going to run those probably every week. I also have another podcast that I would recommend. It's called the All In Podcast. I discovered it about a month ago, and I've been listening to a few episodes. I'm putting that on the recommended list on my YouTube channel. They go into a lot of areas of tech, economics. They also hit some political areas, so I kind of try to stay away from those things. All the gentlemen that participate in this are very intelligent and very well versed on what's happening right now, so I think that that could be very valuable to you. Let's go back and talk about what happened. We did have a flat open, and prices fell after that down to S1 at 4,081. As the day went on, prices chopped above and below S1 before rebounding slightly going into the close. It's a pretty quiet day as far as market action is concerned. We were down 0.25% on below average volume. On the way up, we were below. Now that we're going back down a bit, we're still below. If we see prices falling and a pickup in volume, that could be a real warning sign, but we're not seeing that yet. The technicals are still positive overall. It just looks like we're pulling back. But if we see more downside action, that could shift everything from being positive over to negative. Inflation and interest rates are still the big scenario. Of course, there's the recession debate that's going back and forth from time to time. And then we're still really concerned about this whole banking situation, and is there going to be more shoes to drop in that? Here's the intraday chart. We had a flat open. We came down to S1, danced above and below that level before seeing a little bit of strength coming back into the end of the session. Here's the growth and value charts for the large caps, showing that they spent most of the day underwater, but then a little bit of recuperation at the end. Large cap growth was actually down a little bit more than large cap value, but for the mid caps and small caps, growth did outperform. They were down less. Here's the intraday chart of the SPY. We were pretty much flat until we came into the overnight session where they started to go negative. We took that negativity into the market. That fed over into the session itself, and currently we're drifting a little bit lower with the futures. What are some comments that we can make? The Nasdaq 100, the small caps and the mid caps all underperformed. The Dow was kind of the star performer. Volume continues to be below average. On a short-term basis, our list is getting shorter now, but we still have stochastics, the Williams percent R, and the CMB composite that are extreme positive. On an intermediate-term basis, also the list is getting shorter, the PMO study as well as the CCI 20 period. The dollar was up and interest rates were down. The home builders ETF, we're still working off of that. We've already generated a signal, so now we're watching what will happen going forward. That isn't one of those kind of signals where it comes and goes and then it's not relevant anymore. We're still watching what's happening with that sector. The 30 to the 5 is the only yield curve that's gone back to being normal, where all of our other yield curves are inverted. Sentiment has shifted, so we're considering that neutral. Our trend is still positive. The green line's on top. We're getting a little bit above the moving average, so it's still strengthening, even though it turned down ever so slightly in Wednesday's session. But we're still below 20 overall, so we're not in a trending environment. I've changed our bias over to negative because we've had 2 down days now, and I've switched our momentum to mixed. The economic reports that came out, we had the weekly MBA mortgage applications index. It was down 4.1%. Purchase applications were down 4%. Refinancing applications were down 5%. We also had the ADP employment change report. The private sector employment came in at 145,000. That's a lot weaker than expected. Is that going to feed into the employment situation report? They expected 205,000. Last time we had 261,000. The trade balance also came in weaker than expected at minus 70.5 billion. They expected it to come in at a mere 69 billion. Last time it came in at 68.7 billion on the deficit side. The IHS Market Services PMI came in at 52.6. Last time it was at 53.8. It did weaken a little bit, but it's still above 50, so showing some expansion in the economy. Then the big report was the ISM non-manufacturing. It also came in above 50 at 51.2, weaker than the 54.5 they had expected, and last time it came in at 55.1. Let's look at some Isabel net charts. If you see this chart here, which is a long-term moving average crossover system, I teach this in my class. It's not a perfect system by any means, but it's a very good system to keep you on the right side of the market at the right time. We had crossed over, and you would have gotten into cash at the beginning of 2022 when we crossed over here, and now you're looking at getting back in. That's why I refer to the golden cross at the end of each video, because that's a long-term trend when the 50 goes above the 200. This chart's a little bit different in that it's longer term. This is a weekly chart where it has a 13-week moving average and a 34-week moving average, which is similar to what I show. And you'll see very similar results with other moving average crossover systems. So there are much better systems out there, but this can work for a lot of people. And you can see when the red line's on top, you're long. When it drops below, you're short. And that tends to be a fairly good system to keep you on the right side of the overall trend. We also look at the S&P 500 returns around PMI levels. We're right between the 45 and 50 level. Looking out over the next 12 months, we have a 10% return. Looking over the last 12 months, we've had a 9% return, and this can shift ever so slightly. Even though this reading is below 50 and showing contraction, we can still see some pretty good results in the markets. This is showing that people are really getting out of risky assets and getting more into safe assets. The funds are really flowing out of the riskier assets. Deutsche Bank has their probability of recession at around 90% over the next 12 months. Then they ask, are you likely to increase or decrease your stock exposure in the days and weeks coming up? 37% say that they will increase their exposure. Then looking at the Nasdaq and the breadth, the blue line here is the Nasdaq Composite itself, and it's been doing quite well lately. Although this week so far, it's been pulling back. Down on the bottom, we have the cumulative advanced decline line for the Nasdaq and how it has been lagging behind price. They tend to not get very far apart from each other, even though they are going in the same general direction. This is a bit of a warning sign and suggesting that it's a few companies that are making up the bulk of the Nasdaq's gains. GDP from Goldman Sachs still has us as positive. For the first quarter, they're suggesting that we'll be up to 2.4%. The consensus is this diamond at around 1%, and they don't see us going into a recession at Goldman Sachs, where the consensus does see us going into a recession in the third quarter. Another chart goes all the way back to the 70s. If we're hitting a period of what's called stagflation, where you have really high inflation but no economic growth, what stocks did well during that time? Value, small caps, REITs, which are real estate investment trusts. They ended up doing quite well. And you can just pause this and look at this. Looking at tech relative performance, it is really starting to outperform the rest of the S&P, and that's no surprise. That's what we've been seeing in our charts. Then Edward Yardeni had some interesting things. He had some text. He's saying, what does the bond market know that the equity market doesn't? Last October, we were at a rate on the 10-year at 4.25%. As of right now, we're at 3.29%. During that same time, the S&P is up over 8%. Then he goes on to say, why is this happening? They believe that the banking crisis will soon morph into a credit crunch and a recession, so inflation will continue to fall. Later on, he says, if this is what's happening, the Fed should be done raising their interest rates. If they keep doing that, then we're worried about deflation starting to come in. Now, that may sound cool on the surface, where prices are actually going down, but that's actually worse than inflation if you study economics at all. Here's a chart of the S&P 500 forward PE ratio. That's the blue line, and I show this every week in the weekly video. And here's the 10-year Treasury yield, where they tend to go overall in the same direction with each other, and they've been mimicking that so far. Then he goes on to say later on that he still thinks we're going to have a soft landing, but if we start rolling into trouble, it could get into the commercial real estate market. And that All-In podcast that I was telling you about, in one of the latest issues, they really started to talk about that. Also, the latest batch of economic indicators have been weaker than expected, so the bond market seems to be anticipating that the Citigroup Economic Surprise Index has peaked recently and is about to fall sharply. But then he goes on to say the copper to gold ratio, which I usually cover in the weekly video, it could drop down to about 2%. And then here at the end, he says we're still assigning a 60% subjective probability to a soft landing and 40% of a hard one. Here's the chart of the copper-gold ratio, how it's really been declining as gold's been going up and copper's been going down. Copper is a barometer of the economy, so when that's going up, they tend to see better things going forward. When gold starts going up, that's kind of a hedge against insanity, and when it's going up, they don't see really good things happening in the future. So we see this ratio falling, where the bond yields are also starting to come back down. All right, let's go in and look at our charts. The Ulster Index, even with the 2 down days, is still pretty complacent overall. The VIX ticked up just slightly on the line chart as well as on the bar chart, but we're still well below 20. And volatility picked up just slightly because of the down day. The equity put-call ratio, after giving us this spike, it's been coming down, and that has been giving some good support to stocks because people are overhedged in the market. And when you get too far to one side or the other, the market has a tendency to do the opposite. Looking at a fear gauge, it's ticking down just a little bit, but overall fear is tending to decrease. And here's another fear gauge which ticked up overall, but has spiked as of late. We're still maintaining this risk-off type of posture. Even with the upward move that we've seen, we're seeing high beta stocks compared to the S&P 500 equal weight ratio really going down overall. Looking at our trend, we're still above the moving average, but it's rolling over slightly. The green line's on top, even though it's declining, but we're well below 20 overall, so we're still in a trendless environment. And then looking at the 2-year chart, showing how we came right up to this resistance level, and we've been coming down ever since. If we continue to fall, we'll be keeping an eye on the 50-period moving average. After getting extreme with our Keltner bands way up into the 3rd standard deviation, we're coming back down into the 2nd one right now, but price still is coming up. This is showing that we're not necessarily extreme any longer, so it's worked off that overbought condition. The Williams percent R, even though it's declining, is still extreme. The stochastics, the short term, is coming down, but is still extreme. Intermediate term is coming down but extreme, where the longer term one is now getting into extreme positive territory. The force index has been falling but is still positive. Our moving average tree, we're still above all of the plotted moving averages. We're still positive with the parabolic SAR. We're still positive with the vortex. We ticked up just a little bit in Wednesday's session with the ultimate oscillator, so we're still positive overall there. The CCI 20, although coming down, is still extreme positive. This is another warning sign that we've been watching. The S&P is not outperforming the utilities. In a good solid up move, we would see this line really going up, and it's just chopping sideways and in fact even going down. We're still above support with the Ichimoku cloud, and our PMO study is coming down after showing that the percent of PMOs that are rising got to an extreme reading. The buy signals are rolling over but still extreme, and we're still showing improvement with the PMOs that are above 0. Our BPI continues to be positive. This is suggesting that there's some internal strength in the S&P. It's not really going up all that much, but it is continuing to advance, and it's above 50. Where the NYSE bullish percent index actually turned down in Wednesday's session, the Chaikin money flow, which attempts to measure institutional buying or selling, remains positive. The balance of power is coming down after being extreme. The CMB composite is still extreme, but is coming down. The TTM squeeze continues to be positive. The go, no-go has the darker blue lines here, which is more neutral to positive. We're still maintaining support above this anchored moving average going back to the all-time high. It's right now at 4,074. If we start to really fall, we'll be watching that level on a closing basis. We fell below that intraday, but we were able to close back above that. Then our fib chart, we have 42.16 on the upside if we really get going. If we really start to fall, we're looking at the 40.20 level. Looking at the S&P to the equal weight S&P, it's starting to tick back up, showing that the bigger stocks are having more of an influence than the smaller stocks. The Elder Impulse system for the S&P continues to be neutral. The McClellan Oscillator is no longer extreme positive, and our broader range McClellan Oscillator declined after being extreme. The summation index based on price and volume continue to be positive. The new highs and new lows show that the 5 period is advancing, as is the 10 period, even though it's slowing down a bit. The advanced decline line, declining based on price and volume. You could say this is a negative divergence since volume lagged when we were going up, but we're still positive overall as long as we stay above both of these moving averages. The advanced decline ratio, with the short term getting extreme positive, has now come back down. We're still above 0, but we are declining. Accumulation distribution actually ticked up slightly, and we're getting a little further away from that moving average. Volume continues to decrease. The money flow index, after going above 50, has now dropped below 50. That's negative. On balance volume is still above an advancing moving average, but declining. Our Heiken Ashi is now put in a black candle. And the Kegi chart, it's still positive when it's black, but when it goes down, that's negative. Our boom indicator, we're dropping down below the 20 period extreme reading. We're still holding up okay with the 50 and 200 period moving averages. The financials ticked up just slightly, but are still under a lot of pressure. And the regional ETF against the financial sector just continues to go down. Also, we're looking at regional banks that continue to underperform. This is pretty much that same chart that I just showed you. The blue line is the S&P, where here we have the regional banks index ticking back up, but has really been under a lot of pressure. Looking at our NYSE common stock advanced decline line, we're dropped below the moving average. The S&P is still above the moving average, where the mid caps dropped below the moving average, and the small caps never got above the moving average and continue to decline. The Dow is still above its 50-period moving average, but the diamonds have switched to neutral. The Nasdaq also is starting to come back down after hitting what could be this double top right here. And the Nasdaq 100 is also coming up to overhead resistance and now starting to fall back. If we continue to fall, we'll be looking at these pivot levels. The Qs have stayed at neutral. The micro caps we're watching to see, are they going to generate a new 52-week low? They were down, but not enough to generate one yet. The small caps, after coming up to this pivot level, have now been falling back. Looking at the Russell 2000 index, the RSI has dropped below 50. That's negative. The MACD is still positive, but starting to roll over. If we continue to fall with the small caps, will this support level held, which held really nicely not so long ago? The small caps remain negative with the Elder's Impulse system. The small cap ratio to the S&P continues to decline. And the mid caps are falling back below their 200 period moving average and have just switched over to negative with the Elder Impulse system. The home builders, as we're starting to come down with the S&P, the home builders have been coming down too. The ratio is picking up a little steam to the downside, so we're showing some improvement here, but we're still working off this extreme reading to the downside here. That could be a negative divergence for stocks, and some of the weakness that we're seeing right now could be explained by what we're seeing on this chart. The Composite curve still has a buy signal, and the Pring bottom fisher is also giving a recent buy signal. Bonds continue to see yields fall and prices going up. Then our long-term trend, we're hanging in there. The MACD is still above 0 and going up. What we're trying to evaluate here is this move above the trend line. Was that legitimate? Right now it seems that way, but if we really turn on a daily basis and start heading lower, we'll really want to watch if we can stay above this downward sloping trend line. An update of a few charts here. The 19-day exponential moving average of the advanced decline ratio. It takes a long time to say that. We're coming down a little bit based on price, but we're still above 0. And we're also retreating and above 0 based on volume. The 10-day average of the S&P highs minus the lows are still showing some improvement. This is 10 days, so it takes a little longer for this indicator to move. We're still below 0 with the 5-period moving average when we're looking out at the broad market. And our ratios are showing some more weakness. The Qs are starting to come down, but still above the moving average. The discretionary is starting to show some weakness. Large cap growth is starting to come back down to the moving average when compared to large cap value. Then our growth to value ratios with the large mid caps falling under the moving average and also showing some weakness with the small caps. This is still hanging in there long term. Our 50-period exponential moving average of the new highs minus the lows, we're still above zero here. And I tried to change the thickness of this line to kind of give you a better reading. This red line that you see here is the same as on this chart. I just make it go invisible on this chart to give us some more indication of what's happening. As long as we're above zero, and the longer that we stay above zero, the more this red line is able to improve. The 2-year Treasury, after spiking up, has been coming down. That gave some support to stocks. Now, can it continue as interest rates start to fall? And our staples starting to come back up a little bit, but haven't taken out these spikes, at least yet. What's our outlook for Thursday? The market will be closed on Friday. I still look at economic calendars that have the employment situation coming out on Friday. So there's a real mix-up going on right now about what's happening in Friday's session. This should be the last trading day of the week because they're closed for Good Friday. The technicals are still positive and working off this overbought condition, but what we're watching for now, is there going to be a shift? We have weekly jobless claims coming out, and that's it. And then the whole list of geopolitical events, wondering if more banking information is going to come out. Then we don't have any more speeches, so anything else would be an interview or something off the cuff that one of the Fed governors says. Looking at the Stock Traders Almanac statistics for April 6th, the Dow, the S&P, and the Nasdaq tend to be more positive overall, up 66.7% of the time. The Nasdaq is more neutral to positive, being up 57.1% of the time. We tend to have positive seasonality with April. And then here's all the yearly backdrop things that I go through periodically. Here's the chart showing the green line that we should be in this positive seasonality right now. Another gray line here showing the same thing and also showing that we should be doing quite well with the market right now. So our scenarios can't go with the down one, even though we might be shifting overall. We can't really go with the up one. The market's still working off that overbought condition, but we're not trending. We're still below 20 with the ADX, even though we're above the moving average. The green line is still on top, so we default to positive. So our warning signs, volume still remains below average. The S&P is working off being short and intermediate term overbought. Is the market shifting? The VIX is showing complacency. The S&P is underperforming utilities. Small caps are underperforming as well, and that's been more consistent. The Nasdaq may be declining from that double top that I pointed out in the chart. And then home builders continue to show a negative divergence. That signal is still on the books. So our conclusion, the S&P is positive and working off being overbought. The same thing with the short term and intermediate term. Long term, we're still positive as long as we remain above the 200-day simple moving average. Thank you. I hope you found this video helpful. I hope you have a really good day, and I will talk to you in the next video.